Very good afternoon and welcome to HYCM's online webinar with myself, Giles Coughlin, Chief Currency Analyst here at HYCM. A very good afternoon to you. Thank you for joining me. I'm glad you could make it. Good to see some regulars here today. Shwa, great to have you. Salvatore, Salman, Selva, Tariq, Warren, Mohammed, and a particular welcome to you, May. I think this is your first time, so good to have you here on board, and welcome Warren. I think this is your first time here as well. Right, well, in this next half an hour, what we're trying to do is we're trying to look at the key market events that we have coming up this week, and in order to prepare for them. And we have a very quiet trading week this week in terms of scheduled data. We'll take a look at the calendar in a moment, but we'll notice that it's very quiet, and the main focus is going to be the Jackson Hole Symposium on Thursday. Now, fascinatingly, the topic for the Jackson Hole Symposium is looking ahead at monetary policy for the next decade. So it's a very big topic that's looking ahead. And often at the Jackson Hole Symposium, the Federal Reserve will give a little heads up as to what its monetary policy is. So it's a hotly and highly anticipated event. We'll be covering that, and that will be the main session for the main scheduled event for the week. Now, in terms of different entries, exits that we'll be talking about, please bear in mind that the whole idea of this webinar is that it's to do with education, to do with helping people understand what key market events are coming up. We're looking at entries, exits. We're going to be looking at some currency pairs that have particularly good for swing trading. We're going to be looking at the Australian dollar, New Zealand dollar currency pair. I'm just going to be running through with you why that's really opening up nicely for a swing trade. But remember, the whole idea of this is not trading advice. The whole idea of these webinars is to give guidance. So you look at over my shoulder as a professional trader, and you see how someone with a professional trading and a professional analyst goes about understanding the market, and you learn from that. So that's the whole idea of this. It's not trading advice. And particularly that's important because market conditions change, and what was appropriate on one day can quickly become inappropriate on the following day. So we have to make our own decisions in the market as those market conditions change. But over time, you get to learn how to make those decisions for yourself. That's the whole point of this. Now, we're going to be starting by looking at the market, and the key thing to be looking at is what's going on this morning. Now, we're just going to go over to the other screens, and there we go. That's great. Now, taking a look first of all at the equity markets, we can see here this is US future markets, the Dow Jones and the S&P 500 futures, Nasdaq, DAX, Eurostoxx, ASX 200, and the FTSE 100. And what we can see is that these equity markets have been really pushing higher, and it's been quite a surprising session for me. I've been covering the forexlive.com website. If you go to forexlive.com, I often do some covering live market analysis for the site, and I've been covering that site all morning. And I was expecting to see equity markets pretty subdued today. I was expecting to see those, remember those very weak PMI readings we had from last Friday? Just go into the calendar. If you just go to last week, if you look at we saw some very weak PMI data out of France, Germany, and the Eurozone. There was a little uptick for the UK, but that was kind of overlooked. And that really weighed on equity markets at the end of last week. And that's why we saw equity markets on Friday moving lower. See all the equity markets just moving lower on that Friday. That was because of those very weak PMI data. You can see that here on the Friday. So this week we have started the risk sentiment very positive. Equity markets moving higher. We can see that Brent crude is moving higher. We have some copper prices moving higher. Bond yields are fractionally higher as well. So in this kind of market, we see risk-on sentiment. Now, going back to the main screen, let me just explain to you what a risk-on sentiment market looks like. It looks like this. Risk-on sentiment is when you have lower volatility, you have stocks rallying, which is what we're seeing now, that whole sea of green in the European equity markets. Commodities rising, that's commodities like copper and oil, expect them to increase. Bond yields rising, and that's when you have risk on. Now in the risk on market, certain currency pairs have strength. So you'd be looking for currencies like the Australian dollar, CAD, and the New Zealand dollar will typically have strength in these markets. Now, let me run through something with you. So flipping back to our other screen, we can see that we are seeing broad strength in the Australian dollar, some strength in the Canadian dollar. Now, the New Zealand dollar is a bit weaker, and the reason for the New Zealand dollar weakness is that they have extended their lockdowns. If you remember, New Zealand has been one of those countries that's done very well at fighting COVID-19, and they've really managed to sort of hold the virus back. But recently, they've had to start locking down the country again after a rise in cases. Now, that rise in cases has resulted in some New Zealand dollar weakness because they've had to extend the lockdowns. So we saw some New Zealand dollar weakness. We're also seeing some New Zealand dollar weakness on the Reserve Bank of New Zealand's monetary policy. We'll cover that later when we look at the Australian dollar, New Zealand dollar swing trade. It's a key driver for New Zealand dollar weakness in the coming weeks ahead. But going back to our screen, we can see in our main screen that risk on sentiment supports currencies like the Aussie, the CAD, and New Zealand dollar. Now, it also weakens the Japanese yen and the Swiss franc. So in this kind of environment, we would expect to see Aussie strength, Japanese yen weakness. So for today, I've been looking at a couple of currency pairs to trade, and the currency pairs I've been looking at trading are as follows. I've been looking at trading the Australian dollar Japanese yen pair. Now, haven't been interested in buying up at those highs at 76. Any retracement back down to that 75.80 region I've considered suitable for longs on the Australian dollar Japanese yen pair. On an intraday trading basis, any retracement back to there, the risk on sentiment's good, expect buyers to step in and push price up towards that ADR high, back up towards that 76.15, 76.20 region. That would be the target for buyers. The trade that I've got into on an intraday basis was just the Australian dollar, New Zealand dollar pair, which fell back towards that pivot point. Now, I was expecting the Australian dollar to be strong on the positive risk sentiment. Now, normally, you'd expect the New Zealand dollar to be strong as well. But if you remember that news flow that came out overnight, that the New Zealand has extended their shutdowns, just a little bit of reasons for New Zealand dollar weakness. You can see that the Aussie has ripped up higher against the New Zealand dollar. That's why I was looking at any return back down to that support level. I was looking at that as a really good opportunity for longs and pushing up higher towards that 1.100, 1.10 level. Now, this region here has a very large option expiry level. So just to be aware of that, if you go into the look at the option levels, you can see that on the Aussie New Zealand dollar pair, you can see here there's an option expiry level of $1.4 billion. And you can see the breakdown of that option expiry level. It's mainly puts. So it's mainly sell options. So that means there is a bias for the market to sell from that 1.100 level. Now, those option expiry levels are only valid until about 2 o'clock GMT time. So that's 3 o'clock UK time. So typically what you'd expect is once we get past 2 o'clock, 3 o'clock, you'd expect that option level to stop having the influence it does on price, and I'm anticipating prices to push on higher and move its way up. Now, of course, it may not, but as long as that sentiment remains in the market, as long as we've got positive Australian dollar and a negative New Zealand dollar, I'm expecting that to push higher for the rest of the session. Now, what would be a risk to this outlook? Well, a key risk to this outlook would be something like any very negative US-China or China versus the West news. The Australian dollar, because around 30% of Australia's GDP comes from its trade with China, that means that anything that impacts US, China, impacts the Australian dollar very heavily. So if there was a US-China flare-up, either something to do with either trade tariffs or ongoing trade tensions between the two nations, I'd expect that to invalidate this outlook and drag on the Australian dollar. Similarly, if we had, bad news out of Australian dollar, rising COVID-19 cases, increasing shutdowns, I'd also expect that to invalidate the outlook. Similarly with the Aussie yen pair, if we had a risk-off sentiment return to the market, so if we started seeing equity markets pull lower, then that would also invalidate the Aussie yen long bias as well. But that's how I've started the session. Now, I have been surprised. Risk-on sentiment is pretty positive at the moment, and that's where we are in the market. But with all of that being said, I don't anticipate this risk sentiment lasting very long. Now, let's just take a quick look at the dollar now, because it's just worth just running through what the situation is with the dollar, giving you guys a little bit of a heads up. Now, the dollar has been very weak recently. You can see that weakness, okay? Now, the story in the dollar is what happened. COVID-19 came out, dollar spiked higher. Why? Remember, the dollar is the ultimate safe haven. When the market is really worried, there's one currency that everyone wants. It's the US dollar. Everyone wants it because it's relatively stable. It's also the most liquid currency. 70% of all currency transactions in the world involve the US dollar. So in times of crisis, you really want to have as much dollars as you can. And in fact, there was also such a strong demand for dollars that demand couldn't be met. That's why we saw the huge spike in the US dollar. And then we saw the Federal Reserve opening up these huge swap lines with major central banks to relieve some of that pressure. And that's when the dollar started weakening. And then the Federal Reserve started this unlimited quantitative easing program. That has all resulted in incredible amounts of dollar weakness. Now, this dollar weakness here, okay, is historically high. The most selling that has been the US dollar in about 8 years. Now, on the weekly chart, you see the price broke through that 92.50 region, snapped back in. Technically, this is a rejection of this level, and typically you'd expect prices to spike higher, okay, at least a little bit. So the fundamental picture for the US dollar is still bearish, but that bearishness is due a retracement. So in terms of the big picture, the FOMC minutes on Wednesday of last week showed us two things. One, the Federal Reserve is not wanting to use yield curve control. What's yield curve control, you say? Well, it's this. A yield curve control is when you artificially make sure the yield of your bond stays low. By keeping the yield of your bond low, you help keep interest rates low, okay? So yield curve control is when central banks step in and artificially keep the bond yield low. They do it by buying bonds. That's what makes the yield low. So you can see that in the FOMC minutes last week, the Federal Reserve said, no, we don't want to use yield curve control. We don't think it's necessarily that good. And they didn't mention anything about this topic of average inflation. In other words, they would allow inflation to run high, plus 2%, without doing anything about it. So without embracing yield curve control, not mentioning average inflation targets, this meant that the dollar was able to recover because dollar bears were disappointed. That's why we saw some dollar recovery. Now, this is the important part. This week on Thursday, we have the Jackson Hole Symposium. Now let me show you. Jackson Hole Symposium, and Fed's Chair Jerome Powell will be speaking on monetary policy frame review just before the Jackson Hole proposal. And on that Thursday, we need to be very careful because there's a couple of things we're looking for. One, how do the Fed respond to these rising equity markets? You see, look at how high these equity markets have been rocketing higher, 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 higher. Is the Fed going to be happy with the S&P 500 having risen as high as this? Many analysts and economists are saying that the recovery has been too strong. and that when the Federal Reserve sees this, they're not going to want to say things like, yeah, we're going to give more easing, we're going to give as much help as we can to the economy, because they don't want to artificially keep this equity market rising higher. So the risk is that the Jackson Hole Symposium, Fed Jerome Powell says something like, we've done enough for now, or we're going to be in a wait and see mode. If anything like that happens, then we'd expect to see some dollar strength, okay? And that dollar strength would drag down gold. So that's the thing to be looking out for. If we see Jerome Powell at the Jackson Hole Symposium and there's nothing mentioned about yield curve control, there's nothing mentioned about average inflation targets, it's just kind of, we're in a wait and see mode, then I'd expect some US dollar buying. So that's the event to be really looking out for. Here's the technical signal. We've got a false break of an inside bar. But if Jerome Powell takes that, then that could be a little spike higher. In the short term, at least up to that 94 level. And if we take out that 94 level, we expect to retest back up to that 95, 96 level. So that's the risk for the dollar index. What's going to move this? It's going to be that Jerome Powell, that event that's coming up. So that's the key thing to be aware of. That's the main event. They're the elements to be looking for. Yield curve control, average inflation target, that would result in dollar weakness, and that will push gold markets higher. So this is the way I'll be looking at trading it. Okay. If you get yield curve control mentioned, then we'll see dollar weakness. If Jerome Powell says something like we might consider using yield curve control, or we might consider using negative interest rates, all of that would weaken the dollar, and that would push the euro US dollar, Aussie US dollar, pound US dollar, New Zealand US dollar higher. Okay, it would also rocket gold higher as well. Okay, that would be that sign. Now, if they're in a wait and see mode, we'll have to see. We're worried about rising equity markets, or we think we've done enough for now. That would be dollar strength, and that would be euro US dollar weakness, pound US dollar weakness, and it would also be gold weakness. So you can see in the gold markets that we have. See price just starting to coil up. You see here, this price on the gold chart just starting to coil up, getting ready for a breakout either way. So look out. Jackson Hole Symposium, look out, breakout on the gold and the silver charts. Look at that symmetrical triangle pattern. When you get a break, the price tends to move the length of the pattern. So there's a lot of volatility potentially stored up here, ready for a large potential move higher. Let's now go and look at the main events of the week. So let's go to the following. We're in the following week. Very quiet first half of the week. So you look at this, not any major data. There's nothing of anything here expected. Only thing is got Council Member Governor Wilkins speaking. Look out for the central bank speakers. They can say something. They're not particularly speaking at a relevant topic for monetary policy, but keep an eye out of it. We do have the Canadian Bank of Canada Governor speaking at the Jackson Hole Symposium. So look out for that for CAD traders, and also got Fed Chair Powell speaking. That's the main event that I'm looking for. And look out for the whole day, because the Jackson Hole Symposium agenda sort of released around midnight Wednesday, and then all day Thursday, look out for those Jackson Hole Symposium comments. Okay, that's going to be the business end of the week, and then we'll have a run-in to the Friday. And the symposiums carrying on that Friday as well. So what I'm expecting, relatively quiet first half of the week. So you might want to keep your powder dry. Just wait, just hold fire. Just like this week. I mean, this week was a very similar thing. What I did is I kept keeping my powder dry. And then for me, I entered when we got those very weak French PMI data points. If you notice, we missed all expectations on Friday. This can be a really good way of doing that. Let's go back. Okay, yeah, just go back here. So go back to look at that Friday calendar point. Right, here's the PMI data points here. See the French, see how the reading came at 49, 51, 51.7. You see that little arrow? It tells you on the Icon terminal that that missed the lowest expectations. The lowest expectations for the PMIs, 52.4, 53, 55.8, they missed all across the board. Very bearish. So that told me that was a great opportunity to short the euro. So I shorted the euro out of that 1.1852 region, around, yeah, about 5.2, and shorted it down for the day. I took some profit off here at 1.18 handle, and then I moved the rest of my position to break even. And I'm just sat at break even now at 1.852. Probably going to get stopped out. As I said, I've been surprised by this recent weakness in the US dollar, but nevertheless wanted to keep that position running for now, and is the case. But that's just an example how to do that, how to trade that. Going back to the calendar, they're the key events that we'll be looking at. Now, there's one last thing I want to share with you before I go, and that is the Australian dollar, New Zealand dollar currency pair. Now, this pair, yes, I'm looking at this intraday upside. I also like this pair for a breakout trade to the upside on a swing trade scenario. Now, let me explain to you. All right. We've seen a lot of upside in the Australian dollar against the New Zealand dollar. Now, the reasons for that are as follows. There is a divergence between the two central banks' policies. The Central Bank of Australia is opposed to the idea of interest rates. The Governor Lowe has not been concerned about the strong Australian dollar, so he's not looking at talking the Australian dollar down. He doesn't want to go down negative interest rates, so the Australian dollar is fairly stable and consistent at the moment, and has been rising on these risk-on sentiments that we've seen in the market since early March. Okay, there's pressure to the upside for the Aussie. The New Zealand dollar, on the other hand, has totally opposite pressures. The New Zealand dollar, at their last interest rate meeting, the Reserve Bank of New Zealand expanded their quantitative easing program from $60 billion to $100 billion. They raised it by 40 billion. Now remember, quantitative easing weakens a country's currency. So as soon as the RBNZ did that, that was weak for the New Zealand dollar. So we can see that the Aussie is ripping higher against the New Zealand dollar. Now, the next thing is that the Reserve Bank of New Zealand also extended the amount of time they will be taking for implementing these bond purchases from like 12 months to over 20 months. So they extended the program. So they're doing more for longer, and then the cherry on the cake, so to speak, was when the governor and the deputy governor have both said that they're opening the door and actively considering negative interest rates. Interest rates at the moment for the RBNZ are positive 0.25% basis points, but now they're opening up negative interest rates. That means there's a divergence between the two central banks. That means any retracements on this pair are most likely to be bought. So any retracement back down to that 1.0880, 860 level, we would expect to find buyers. So this is a key level going forward here, okay? So that's the level to be looking out for. And on a swing trade perspective, you know, trades that you hold for days or weeks, this looks good for potential. Now, what could go wrong? There's plenty that could go wrong, of course. If the situation improves for New Zealand, then they walk away from negative interest rates, and this trade becomes invalid. And if the situation radically deteriorates for Australia and they start moving towards negative interest rate, that also invalidates this outlook. Also, if there's any very serious US-China news, that too will invalidate this outlook, because the Australian dollar tends to get hit harder than the New Zealand dollar. So there's three major risks to that outlook. What would make it go wrong. In terms of entries, the entry that I'm looking for is any retracement back down, ideally towards that 50 retracement level, or that slightly higher up, that 1.0880. So any from here, 1.0880 down to 1.0810 would be ideal as an entry point. And looking higher, you can see that once the price breaks through that ascending trend line, that really does open the way up higher to 1.1200 and beyond and higher. Okay, so there's real potential here. Break and close above that level, and we're looking to reach up higher. Okay, everybody, I hope that that's been a helpful time for you. Yeah, Shua, that Aussie yen. Yeah, absolutely. Now, I was looking at this today, and now looking at the Aussie yen, yes, we can see that trend line on the hourly chart, on the daily chart, has been broken. Okay, so we saw that breaking trend line. Price is now testing above that. So that risk-on sentiment, Shua, is pushing the Aussie yen higher. So if that risk sentiment remains, we expect this price to keep moving higher, and that short bias is invalid. That negative sentiment on Friday was because of those weak European PMIs. So it's been positive vaccine news that supported risk-on sentiment today, like the US are potentially looking at the emergency use of plasma. They're approving that. They're fast-tracking the AstraZeneca and Oxford vaccine, and we also have China, warranting an emergency COVID-19 vaccine use. That's all been positive for risk sentiment. So a close in this level will invalidate that short-term bias. A break up into that level, as we're seeing now, it gives the pair a buying bias. Okay, so break and close above that trend line, it opens up price higher. So Shra, that's what we're looking on that. Yeah, Shra, yeah. Shra's hoping for a big event, Powell and Trump to support the dollar. Yeah, the way to play this week is to be waiting for that big event. That's the time. That's keep all your powder dry until Thursday, when we're likely to get some clear direction as the market reacts to what Powell and Trump are doing. So yeah, as I say, I don't know which way it's going to go, but I'm just getting ahead and prepared for the event. Finally, I wanted to say that I am away on holiday, and I will not be back until September. I think I'm back on September the 9th. So I will be back here, not next Monday, but the Monday afterwards. And I'm also away, for you guys who are HYCM clients, I'm also away for the daily, weekly webinar as well. I hope I've given you guys plenty to think about while I'm away. Particularly do look out for that Aussie New Zealand dollar currency pair. Yeah, thank you, Olafemi. I'm glad that's been helpful. And do please come back on the 9th of September, where we'll be sharing some more insights to help you guys just have a little bit of an edge as to what the market's expecting. Yeah, thanks, Shra. I hope to have a good vacation. Thank you very much. Thank you, one and all, for your contribution and the time we spend. Thank you very much for your questions. I'm going to miss not seeing you guys on the Wednesdays, but I do hope you stay safe and trade well. Take care, everybody now. Goodbye.